Under the assumption that gold continues to trade as it has with peaks and valleys, periods of price ascent and price decline, overall gold will move higher.
All right. All right. I think that's a very interesting thesis. So that aside, because it's not happening right away, and we're speculating as to whether or not these CBDCs could be backed by gold. But that aside, what are the short-term charts showing you about the gold price in the intermediate term?
Well, the chart that I have on the screen looks at various price points in terms of resistance. Now that we've broken below 65, which was former support 1929. Above that, I see resistance at 2000 and then at 2016. Also 85 now that we've broken below that. Those are the key levels to watch on a technical basis.
$2,000. All right. Now, going back to my initial point at the start of the interview, this momentum that we saw since the beginning of April, how likely is that to continue? Breach resistance of $2,000. I mean, you've stated the resistance, but we're talking about a breach now and a sustained move upwards. How likely is that to happen?
Under the assumption that gold continues to trade as it has with peaks and valleys, periods of price ascent and price decline, overall gold will move higher. I'm not saying straight up, but I am saying that the value will continue to grow. My long-term prognosis is for it to take out the former record high at 2088. And that might sound far-fetched, but realize just recently we hit $10 shy of that price point.
Yeah. It's been, I'm just looking at the chart. It's been twice now in the last 2 years that gold touched above $2,000, but failed to sustain that level for any significant period of time or break above that significantly, right? Once in August 2020, and then I'm looking at the chart now, back in March, it moved up above $2,000 as well. Now, I'm just wondering whether or not this is some sort of psychological level that investors cannot see gold moving up much higher above $2,000, or maybe there's a technical reason as to why gold just stalls at that level. Can you explain?
I believe you hit the nail on the head. What happens at a certain new price high or approaching a recent price high is technically sellers come into the market, whether they're covering shorts, and they bid the precious yellow metal lower. I think it's 100% a technical move in nature, because typically we see these declines at points in which no major fundamental event has occurred that might precipitate it. And so it is a technical move. It's just like 2000. We saw it hit 2003 the other day, and then it came down from there. Did anything change in the underlying fundamental forces that took it to 2000? I would have to say no. If anything, those events have escalated.
Yes.
And so how can they escalate and yet gold have pressure to move down? I believe it is market technicians, short-term traders pulling profits.
What are these numbers you've marked in the chart? I'm just curious. 2, 3, 4, and 5. Are those inflection points?
When you look, you mean the longer term chart? No, what that is a basic Elliott wave count. For those unfamiliar with Elliott wave theory, in essence, what he says is that prices move in a methodical and defined pattern that repeats itself over time. And that is composed of a series of price movements higher, price movements lower. He further defined it as a full cycle being 8 waves. The first 5 waves in a bullish market means waves 1, 3, and 5 move to higher ground. And then you have what's called a corrective wave, 2 and 4 taking it lower. At that point, you reach a correction, some sort of an ABC. If it's still a bullish market in terms of the undertones, it repeats itself, and it will repeat itself until the fundamental forces that created the bullish market sentiment wane, dissipate, or reverse. So what you're looking at is a model in which one possibility is the price points it will hit before it declines, where it will decline to, and then how high it will move on the next one. And there's simple mathematical formulas. So for example, the first rally is called a benchmark. It's very difficult to actually gauge that. But once it comes down, it's an accepted fact that it will either retrace by 38.2% or 61.8%, some occasions 50%, but that's more of a stock number. Now, then you enter a third wave. The rule or model that we use as a market technician is that wave 3 first cannot be the shortest of an impulse wave, but more importantly, it should move 1.61% above the range in 1. And then finally, when you get to wave 5, that should roughly equal wave 1 or a 0.618% extension. This is going to be a little bit shorter. That's just a basic model. It is benchmarks that we look for. It's an art and a science, but those numbers are not an art. They are purely science because they are based upon Fibonacci numbers. And that sequence itself, which is the most important sequence in nature, I believe it is the blueprint of how nature expands and builds upon itself, is simply by adding 1 plus 1, which equals 2, 2 plus 1, which equals 3, and so forth. And the difference between each of those numbers is 0.618%.